So, what is value investing? Well, I'm sure most people have heard of Warren Buffett. He's usually called the most successful investor in history, and he's currently, I think, the third richest person in the world. Now, Warren Buffett, when he was a young man and a student at Columbia Business School, learned the principles of value investing from two guys, Benjamin Graham and David Dodd. They'd written a book in the 30s called Security Analysis, and I think Graham did a follow-up 15 years later or so called The Intelligent Investor. I first read that when I was 18 or 19, didn't really understand it, went way over my head. But Warren Buffett took the principles of value investing and applied it over the next 50 years or so to become extremely successful as an investor. Well, look, the best way I think of explaining it is to use the value investing cafe analogy. This is the way Tony Kynaston has explained it to me over the course of the last year as we've been doing our podcast, the QAV Value Investing Podcast. Imagine you want to buy a cafe in your neighborhood. It seems to be doing quite well from the outside. You like the coffee, you like the ambiance, and you approach the owner and say, I'd like to buy your cafe. How much do you want for it? She said, well, yes, it's for sale and I want $1 million. How do you know if $1 million is a reasonable amount of money to pay for the business? Well, you'd probably look at a number of different things. You'd probably look at its profit. How much net profit, revenue less expenses, is it generating every year? If it's generating $1 million of net profit every year, probably a good buy, right? You spend $1 million, you get $1 million. Within 1 year, you'll have paid back your original investment. Second year, it's all profit. If, on the other hand, it's only making $50,000 of net profit a year, or it's losing money, maybe that $1 million may not seem like a good investment. We would also look at something like its assets. What does it own versus what does it owe? Its liabilities, its debts. If it has no debts, and let's say the property that it's sitting on is owned by the cafe and it's worth $1.2 million, again, $1 million is a good deal. You spend $1 million, you get something worth 1.2. You're getting $1.20 for the dollar that you spend, every dollar that you spend, so it's a good deal. And you'd look at other things like how happy are the customers? Has it got more customers today than it had last year and the year before that? Is it constantly making more profit each year? Is it growing? What's the competition like? What's going to happen to the suburb over the next few years? What's going to happen to the supply of coffee? What the cost of coffee beans? Is that going to go up or going to go down? You'd look at all these sorts of things and try and make an intelligent decision before you invested the money. Well, value investing, what Benjamin Graham and Dodd and Warren Buffett and Tony Kynaston do is they apply the same sort of thinking, the same sort of rationale to investing in equities, stocks and shares that are publicly listed on the stock exchange. Now, that may seem like common sense, but that is, in fact, not what most people do when they're investing in equities. It's very easy to get caught up in the emotion of equities when the share price is going up in a particular stock, like some sort of a tech stock, a high growth stock, that there's a lot of exuberance and the shares might be going up. People feel the fear that they might miss out, so they'll jump on board without really doing a lot of analysis, just in the hope that it goes up. And as Tony says, well, that's not investing, that's gambling, really. And then conversely, if the share price is going down in a stock or in the market as a whole, people get scared and they don't want to lose their money, so they will sell and jump out of a stock regardless of whether or not it's a good business or not. Because they're being driven by fear and greed, and that's the way that most people unfortunately invest. Value investing brings a level of discipline, it brings a system, a methodology to help you decide what to buy, when to buy it, and when to sell it, and tries to remove the emotion. So it's purely a logical, rational decision-making process. And it looks at primarily the financial data of the business, which as a publicly listed company, the business needs to report on usually twice a year. Now, I think every value investor goes about their analysis in a slightly different way. Most these days use some form of DCF, which I used to think stood for Don't Come Friday, because I got told that a lot during my working career, but it actually means discounted cash flow. So they're looking at what is the business going to be worth? What is it worth today? What is a share worth today? What is the business going to be doing? How's it going to be performing 5 years, 10 years, 15 years from now? And then discounts that back to figure out what you should be paying for it today. But basically it comes down to this: trying to buy shares in a business that is performing well. By that I mean it's profitable and has been consistently profitable for a period of time. It's under good management. You want to buy shares in that business, but you want to buy them at a discount to its actual valuation. So getting back to the cafe analogy, you don't want, if the business is actually worth $1 million, you want to make sure you're not paying $1.2 million for it. In fact, you'd like to pay $700,000 for it. So you have what's called a margin of safety, just in case some of your calculations are wrong and it takes longer for the business to return your investment than you had calculated. You've got some safety in there. You're paying less for the business than you think it's actually worth. You're getting it on discount. As one famous value investor said, you should buy shares like you buy anything else when they go on sale. Now, why are these shares going to be undervalued in the marketplace? Well, there's a whole bunch of different reasons. It may not be a popular stock at the moment. Maybe the business has had a couple of problems recently, some bad press, maybe managing director or CEO left and the shares took a hit. Just for, again, emotional reasons, some investors pulled out, other people followed because they were like, oh, what's going on? I'm going to sell just in case I don't get caught. Our job as value investors is to identify those businesses that are undervalued but are actually good performing businesses, and to buy them and then basically to hold. Warren Buffett says that a good business will eventually be recognized by the market and its shares will eventually catch up. The share price will eventually catch up to the value of the business. So that's all that value investing is. It's a discipline. And the thing that I like about Tony's method, Tony Kynaston, as I said, my teacher and co-host on the QAV podcast, is that Tony's been studying value investing for 25, 30 years. He's very, very good at it. He's made a lot of money out of it. His portfolio has returned an average of 19.5% over the last 25 years. Now, to put that in perspective, Warren Buffett, over 48 years, I think the last figures I saw was up to 2012, 48 years, his portfolio, Berkshire Hathaway, has returned 19.7% per year on average. So Tony's doing pretty well. Tony has condensed all of the things that he's learned about value investing into a spreadsheet. And that's how he's taught it to me. We go through the spreadsheet, we plug in certain bits of financial data, and then we give the stock, the share, the company, a score based on how it's performing in each of these different areas, and we look at different ratios and that kind of thing. We add up those scores and we finish with a buy or a don't buy, and that's pretty much as simple as it can get. Anyone can learn it. You don't need to know anything about any particular industry. You don't need to go into too much detail on any particular business or its products or its services, or you don't need to look at macroeconomic events like is the economy going up or going down, or interest rates going up or going down, or any of that kind of stuff. We're purely looking at the financial metrics of the business. Anyway, so that's how we do it. It's a little bit of an introduction into value investing. Check it out, qavpodcast.com.au. Good luck.